Okay, let's do the little disclaimer thing first and we'll get on with the show. Access this webinar is for educational and informational purposes only. Consult a licensed broker or registered investment advisor before placing any trades. All securities and orders are discussed and tracked. All securities and orders are discussed, are tracked and monitored in virtual trading accounts. That's not a good start. Virtual account prices and returns may differ from actual trading results. Commission costs are excluded. Neither PhilStockWorld.com, PSW, nor its affiliates, nor any of their respective officers, personnel, representatives, agents, or independent contractors are in such capacity as licensed financial advisors, registered investment advisors, or registered broker dealers. Nothing contained in this webinar website promotional material constitutes promotion, recommendation, solicitation, or offer of any particular investment security or transaction. Trading options involves risk. Visit the OCC website, www.optionsclearing.com, to read characteristics and risks of standardized options. PSW provides education and training services that are meant to teach the risks and potential rewards of trading options. We are not a service that tells you what to trade. We are not implying or guaranteeing any profit. As always, do not trade with money that you cannot afford to lose. Past performance does not equal future results, and results discussed in this webinar are not typical and are only valid on that specific or identified date. Your results may vary. By assessing this webinar, you agree to hold the above harmless from any losses that you may incur as a result of the information discussed in the media identified above. By accessing the webinar, you agree to be placed on our mailing list and receive our newsletter. Rest assured, we take your privacy very seriously, and we will not distribute or sell your information to anyone. All right, that is fan-freaking-tastic. All right, so let's see what's going on. We'll start off with just taking a look at the charts. Disney, why is Disney up there? Disney is booming. Look at that stock. YM. Let's say it's not. I knew the Dow wasn't doing that. All right. So we've got the Dow up 70 for the day. As you can see over the week, though, it's still down. S&P is just about flat for the week. NASDAQ is up for the week, and the Russell is basically flat for the week. Oil flat for the week. Brent crude flat, although up and down a lot. Gasoline flat for the it's up because it started off down here. Wait, what is this? Oh, okay. So here's 200. So that, Friday it finished off down like 201. So this is actually a pretty big move up considering. Natural gas came off its highs a bit. Gold under 1200, which we like it long down there. Silver 1440, and I like it better when it's down here. Copper flat, and coffee. I forgot to buy my coffee this morning. God damn it! And I said that too. I even said it to everyone so that this was time to buy coffee. Oh, that's annoying. That's like a 1.5 cent move on a day. It's good for like a few $100. Oh well. Too late now. Now I gotta hope it comes back again because I'll be really pissed if it takes off. We got the Fed coming up shortly, so everything's hesitant into the Fed, and then the Fed's going to announce. Now, almost certainly they're going to announce that they're going to tighten, so I'm not quite sure what all the hubbub would be about. Everybody thinks they're going to tighten. If they don't tighten, it'll be a surprise. Can't even imagine why they would say they wouldn't tighten. And if they and the only thing they can do that would really surprise people is they tighten 0.5 point instead of 1/4 point, which is also very doubtful because that would be kind of drastic after deciding not to tighten meeting after meeting after meeting. They suddenly say, oh, now we got to tighten 0.5 point. That would seem like they're crazy. And they don't want to seem crazy. So I think that's where we're going to be. Ooh, Papa John's popped like almost 10% this morning. That's nice. We have Papa John's. So other than that, there's not much going on. Everything's waiting on the Fed. I haven't seen a lot of important news happening. We got a third person has come out and accused Kavanaugh of being a bad boy. So that's kind of important. Well, it's important on the political side, but it doesn't really affect the market, it just kind of has this overall effect on like what's going on in the government and how disorganized things are and how badly the election is going to go for the Republicans. And if you think all this stuff in the market is a result of successful Republican policy, well, say goodbye to it, because I don't think they're going to keep the House and Senate. the way this is looking. It's looking very bad for them right now. If they can't get Kavanaugh through, it's going to piss off their own base. So we're going to say, how can you not confirm a Supreme Court judge when we have the whole House and the Senate and the president? If you can't get a judge under those conditions, you're in trouble. And the reason is they picked a guy who had a checkered past without vetting him because the only thing they really vet you for is whether or not you're going to go along with their views. If you go along with their views, you get in. That's a big candidate to them. They don't actually look at the guy's background properly. That's what vetting is all about. You have to have your people look into the background of your candidates as much as your opponents are going to. Because if you don't do as good of a job as your opponents are going to, then they're going to get something on you if they find it. But it's just bad. It's bad leadership. It's not what you want. It's certainly not the kind of guys who want protecting you from terrorism. Who's even saying? I can't think. Oh, three is saying this. Sri says, I have no TV and try to manage to avoid the newspapers. Everyone in Trump country is convinced the market will go up. Only question in their minds is, will the S&P stop after 3,000 and go right to 3,200? Most are fully invested. That's scary. With few with money to spare, using any dip to buy more. Mood-wise, about 20 days or so ago, when allegations against Kavanaugh came out, it started a gloom of utter dread, like a huge shadow descended. No small talk, nothing, just long faces and silence everywhere, school lines, water fountain, you name it. Almost, but not quite like the week before the presidential election when everyone thought Hillary would win. In the last few days, it seems I see some smiling faces again, even a few jokes about the whole mess seems to be easing up a bit, but still worry lines on the foreheads. Okay, so, I mean, people do seem to care about this Kavanaugh thing, but I don't see, look, I don't want to say it can't happen. There's now 3 people accusing him. Now, let's see what's up in here's my Twitter. Here's Twitter. So we'll search for that. Kavanaugh. It's Kavanaugh. Four people corroborate her assault claim, so that's nice. Attorneys could see this is what's going on, folks. Okay. Fourth, okay. And Russell and Freed, friends who support the California possessions. Well, it's interesting. She has friends who are supporting it. They didn't witness it. Oh, she was told about it in 2013, blah, blah, blah. Oh, okay. Well, yeah, I guess that's basically showing that she didn't just make it up for this week or something. Anyway, so I don't know what the details are, but there's a third person now coming forth and saying that he was did some bad stuff. So it would be really weird if he gets through at this point, but I wouldn't count it out because who knows what's going on now. Things are just completely crazy. So, look, market-wise, I mean, the biggest thing that matters is the market is pricing in this permanent tax break and ignoring any bother about the fact that we're so massively in debt. And so far, it's not even been an election issue. I mean, somebody's bringing up the freaking debt as an election issue, and I think that might be just because the Democrats are like, well, we can't really stop that right now. I mean, there's just too much crap going on. I mean, if anything, in order to fight climate change, we're going to have to take on a lot more debt because that needs to be addressed very quickly. I think that might be a Democratic priority if they get in because they feel like we just wasted a couple of years of not doing anything about the climate change, and meanwhile, like things are falling apart. But anyway, so we'll see what happens. I wanted to short the Nasdaq at 7,600. It tested 7,600, but then it didn't stay under it. So unfortunately, that's a no trade. There's nothing else. There's nothing more interesting to short than the Nasdaq. But ahead of the Fed, it's just too crazy. The same thing goes for all these futures. It's just all too crazy right now. As I said, coffee stopped trading already, otherwise I would jump on that. I think it stopped trading. Let's take a look. No, maybe not. Oh, no. There you go. I got one. Okay. So there's a long coffee at 105.9. I would have liked to have gotten it at 105 when I was talking about it this morning, but I forgot. But I'll take 105 and I'll buy another one if it goes down here again or down here. And I mean, really, if it goes to 105, I'll buy another one. And if it goes down to 104, I'll buy another two. So that'll be my long position if I get it. And meanwhile, I'll have to just wait and see what happens otherwise. So nothing too interesting there. I guess we can go over the new trades I was looking at today. So we'll talk about that. See if there's any questions. Nope. Okay. So in the live member chat room today, what do we do? Oh, well, so let's talk about the Fed. I mean, I was talking about that this morning. You know, it's a little hard to see, but hang on, Control Shift. 1, 2, 3, 4. How's that? That's big, right? These are the expected changes from the last statement. So they changed the words here. The committee expects further gradual increases. I don't know what for now means. That's not, they're not going to write for now. So basically, that's not a change. The committee decided to raise the target rate. So in view of the expected labor market conditions, blah, 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 the target rate for the funds rate is going to be raised from 1.34, 1.75 to 2, just up a quarter, 2.22 is the bottom then, and to 2.25%. The stance of the policy remains accommodative. And that's interesting. They're going to say take out remains accommodative and say supports a strong labor market conditions. That's it though. All they're going to do basically is no change in language, no change in anything else, other than they're going to say they're going to change the rate and they're going to say, and this is not for sure, but this is what's expected, and they're going to just stop saying accommodative. Although to me, 2.25% is pretty damn accommodative. What's more important is these 2021 projections that have come out, and we'll see if we're holding on to that 2.2% number here. Unemployment rate's a wild card. I don't know what they mean by upward signal slow. Well, obviously upward signal slowdown, but I don't think they're going to project that. PCE inflation, because we have such a labor shortage now, it's hard to say you're going to have a sudden slowdown after 2 years. PCE inflation, they're going to certainly not say that's going to be low or high. They don't change it if they can. And the core PCE is the same. It's all bullshit because you know, anybody who buys stuff knows that there's plenty of inflation, but not the kind the Fed counts. That's what they care about. And as far as the dot plot goes, we are here. People need to keep that in mind. We're here. There's nobody who doesn't think we're going to be there. Nobody, not one dot below here. Into next summer, we're talking up here at 3, which is 1 whole %. So 4 more hikes in the next 12 months. So not even 12 months, 9 months. Probably there's like maybe, I think 7 meetings in between now and then. So you're talking about 4 raises in the next 7 meetings after this raise. So that's a lot of hiking. And that's going to certainly have some kind of negative impact on the market, but it is not in any way, shape, or form showing up. It's crazy. I don't know what to say about that because it just seems so odd to me what's going on right now. People are just ignoring everything that's going on that's not good is being completely ignored. I said here, slowing economy, rising interest rates, a trade war which is spinning out of control, and again, nobody seems to care. It's the weirdest thing. The NASDAQ popped today, so this is no longer danger, but it was right here on the 20-day moving average. The Russell, I believe, is up for the day. So it's holding on to its 50-day moving average, but what matters is what happens after the Fed and after Powell makes a speech. Then we'll see where we really are. This should be back to the Russell. So let's see what we got. RTY. And the Russell is down a tick for the day. So the Russell is actually kind of in danger here because the 50-day moving average is 1701. And the Russell itself is at 1712. So not right at it yet. It tested it earlier and it popped back off. So we're in that zone though. When it's that close to breaking the 50-day moving average, you better pay attention to what's going on. So meanwhile, what we're going to talk about in chat is the trade ideas we had. We'll do that until we get up to the Fed, I think. Wait. Oh, wait, are there questions? Let me see. Three says, please, you need to help with my LB positions, a lesson adjusting. She thinks LB is going to be 40. Let's see. LB hits 40 around January 2019. 3 is long. 7 January 2020, 30-45 bull call spreads at 5. All right, let's take a look. So LB is where? LB is right about 30, I think. Hang on. That one, yeah. So LB's down at 30. And 3 has the 2020 30-45 bull call spread, paid 5, and long January 2020 calls. You have a 30-45 spread and long calls. It's such a weird way to play. First of all, you should not be in a position like that in the first place. Okay, I don't know why you have 20, 35 calls. That's just so strange, especially naked. The whole point of what we do is we teach people to sell premium. So when you buy premium, you're doing the exact opposite of what we teach. The 35 calls are now $3, and 3 says paid $5.95, so they're down 50% basically. The January 30s are $4.60, and 3 paid 5 for the spread, so you can still salvage this. So what I would do is I would give up on those long calls because that's ridiculous. I'd go to 2021. So I take the 30s here, which are $5, and I would cash those, which is what, 7 times 5 is $3,500. And I would take the 10 long calls at $3, which is $3,000. So now we're talking about $6,500. And I would buy the, if you can get those for $11.20, that's a good deal. So say $11.20, $11.50 on the 20s, and you got $6,000. So you want to have less than 5. So let's say, what do we say, the 20s? So you can move it to the 20-30 bull call spread, and if it's like $11.50 and $5.50, say that's going to be $6. So you can get 10 of those for $6,000. And those are in the money. Actually, I go to the 32.50s. It would cost you a little bit more, but it's worth it because these are still $4.50 at least. So for $1, you get $2.50 more upside. So I'd go with the 20-32.50 bull call spread. Assuming you can get that for like, what do we say is $4.50 and $11.50, $7. So if that's $7, it'd be $7,000. So you're cashing in $6,500. So you're paying $500 more, but now you're in a spread that's in the money. It's $10 in the money. So you're actually $10,000 in the money on the spread. So it's well worth the extra few $100 you put into the spread. It doesn't say you sold puts. I don't know if you sold puts or not. I would sell some puts. If you sell 5 of the 25 puts, they're going to be $450 also, $490 in fact. That's going to get you $2,500 back in your pocket too. And since you have 10 longs, you can go out to January and you can sell. Like, where are they? They're at 30. You can sell 3 of the 3250 calls. So if you do 1/3 cover there, this is the problem. You're not covering. You're not selling premium. So every time it goes down, you do nothing but lose. If you have a spread and you have sensible positions, you have that. Oh, I'm sorry, we have those leftovers. So you don't want to be too heavy on the short call sale because you have the leftover short 45s, 2020 45s. You can just buy them back though. I mean, honestly, it's not worth it. But if it's a margin problem, I'd buy them back. But if not, I would leave them to expire worthless. It's only 7 covered out of 10. But you can sell 3 of the short 3250s, and you pick up, what do we say they were? $1.40. Let's say $1.40. So it's $1.38 there. So let's say $1.40. That's still $420. And it doesn't seem like a big deal, $420, but you know, if you do that 8 times once each quarter for the next 2 years, you're going to pick up you're going to pick up $3,500. That's what being in the house is about. If you know you're going to get $3,500 worth of income on your spread, you're going to do well. You only paid $3,000 for the spread, so you're going to get a 0-cost spread. Then whatever you're in the money is going to be profit. But you don't buy premium ever. Did I say ever? Don't ever buy premium. Sell premium. Don't buy it because premium expires worthless. Always. Doesn't matter if the stock goes up, your premium still expires worthless. If you buy the 2020 $35 calls for $3, and even if you're at 35, they're worth 0. If you're at 38, the options are worth 3, but your premium becomes 0. You still lost the premium. It's the worst thing you can possibly do is buy premium. It's absolutely going to lose. And the more you buy, the more you will lose. If you have a portfolio full of positions where you're the sucker that bought the premium, then you will lose quite a lot of money over time. Now, maybe you were brilliant in your picks, and maybe they'll do so well that they'll wash out all the premium you lose. But that doesn't mean you didn't lose the premium. It just means you did really well in your picks. But it's not a good way to play. It's a terrible, terrible way to play. You're just throwing money out the window constantly and a guaranteed sure thing. It's like putting money in the bank at -5%. And you can say, oh, well, the money's safe at least. It's not safe. You're losing 5%. And that's what it is when you play roulette also. A roulette wheel has 36 numbers plus 0 and double 0, so it's 38 numbers. Yet what do they pay you when you hit it? Pay 35 to 1. They're ripping you off for 3 numbers. 3 numbers is 10% of the numbers. So every time they spin that wheel, they're stealing 10% of your money. You just don't realize it because you're playing a game where sometimes you win 35 times. And when you win 35 times, you're like, oh, I don't care about the times I lose. This is great. And that's what it is when you sell premium. We sell premium to hundreds and hundreds of people, and sometimes they beat us. But you know what? 90% of the time, they don't beat us. And we win, and we take the money. And we went over the portfolios last week, so I'm going to go over it again. I mean, these portfolios which follow this principle are all outperforming the market by a mile. I don't understand why at this stage, why do I still have to sit here and tell people not to buy premium when our job is to sell premium? It's a foolish, stupid way to play the market. And I know everybody plays it that way. That's why they're all idiots. I don't know what I can say to make people understand this is not the way you should be playing. So that's important. Now, Sri's also saying, let's see, have the January 2020 puts, short 30 puts at 650 and 35 puts. You know, and again, with these multiple positions, it doesn't make any sense to have more than, well, why do you have different spreads, different strikes? So the 35s were sold for 650, they're 850, and the 30s were sold for, no, the 30s were sold for 650. That doesn't make any sense, right? I guess the 30s were sold more recently. So the 30s sold for 650 and now 550, and the 35s were sold for 760, now 860. So these made $1 and these lost $1. So I would just kill them all, and I would sell a reasonable amount. And frankly, if you sold 7, you shouldn't be selling more than a few over here. But I would sell a reasonable amount of the 30 puts, which are $7. So you're lower and you sell them for $7. But, you know, I mean, you know, the margin on these isn't that bad, really. I mean, if you get, they got 70, well, let's say you get 720. So if you sell these things for 720, I mean, hell, I can see that, and that'd be the whole play on the stock. If you sell 10 for 720, the margin, you collect $7,200, and the margin requirement is $25.80. So that's very margin efficient selling those puts. So you can make up to $7,200 using $2,500 in margin. That's the way you play something. That's on 10. And obviously, if you're only playing 7 long or 10 long, you shouldn't be, you know, you should not be selling 10 puts. 5 puts would be plenty. 4 puts, 3 puts. You don't need to sell that many. And then, you know, then it's like great money. Then it pays for your spread. That's the whole point of these things, is you pay for the spread. Because you sell premium to pay for your spread. You don't buy premium ever. The only reason you buy premium is because you're going to sell more premium to somebody else. So you're using, so, you know, if I'm going to buy the 30s, not the 30s, I wouldn't buy the 30s because there's too much premium. If I bought the 25s for $7, let's say, make it easier, and we're at 30, so obviously 25 plus 7 is 32, so I'm paying $2 of premium. So I'm going to damn well make sure I sell at least $2 worth of premium to somebody else to cover it. So then I pick my target, and let's say my target is 35, so I sell these for $3. So now I haven't, instead of buying $2 worth of premium, I've now netted into the position for $4. You know, 7 minus 3 is 4. So now I have the 25-35 spread for $4. It's a $10 spread. I have, and we're at 30. So I haven't just not paid premium, I've taken $1 of premium to take the position. I've gotten in at a discount. And again, that negative premium that I came in with, it will expire worthless, and I will gain $1 when my premium expires, not lose $1. It is the exact 100% opposite strategy of buying premium, and it's 1,000% more successful when you use it. But you've got to discipline yourself. You've got to stop messing around. People, I mean, I know it's fun to get it to buy an option and it goes up 10 times and you go, oh, I'm such a genius, but I guess the direction right. It's no different than the roulette wheel. It's just not the way to play. You want to consistently be selling premium. You want to look for chances to sell more premium, which goes back to my point of the portfolio review. Oh, not the portfolio review. We did new trades. Now, why do we do new trades? Because I was looking for some longs, because I was thinking, you know what, we could use some more longs. We have a lot of cash. And our long-term portfolio is up like The long-term portfolio is up like 80, 90%. So, you know, and it's got mostly cash, so we should do something with the cash and deploy it. I don't know how long the market rally will last, but if it lasts another few months, I certainly don't want to be caught short, right? So, what was that about? Oh, that's UBS. So I added a few cool things today. So here are the hedges that we put up in chat, and we'll talk about them one by one. In the long-term portfolio, we already have Best Buy, and what we have is long. Best Buy's at 19. We have the 15, 22.50 bull call spread, and we sold the 17.50 puts. And I didn't, oh, for some reason I didn't do the chart for Best Buy. Where is it? Chart. Not Best Buy, this is Bye Bye Baby. No, not Bye Bye Baby, Bed Bath & Beyond, that's it. Sorry, I'm getting confused. This is Bed Bath & Beyond. So just basically it's a retail value play. I think this is a great floor. We've been watching them all year. So we're really happy to get in here. But also, what I was looking for, I've been spending all week doing this, is I was looking for stocks that pay really good premiums. And there aren't very many that pay good premiums because the VIX is so low. But Bed Bath & Beyond at 19 will pay us, we can sell the January 20 calls. So look, you know, look at where the chart is, right? They're here, the 20's got that little line coming down. It's gonna be hard to break over that line. I don't expect, you know, anything exciting coming out of Bed Bath & Beyond for the quarter. We already have a very big long position. So since I have a long established position that's gonna pay us, what do we pay for this position? 13,950 minus 56 is 8 and 3, so about 83 less 2 is 63. Let's say we pay about $6,000, and it's a 30 of the 15, 22, 50 spread. So it's about a $21,000 spread that we paid. What did I say we paid $6,000 for? Yeah, so we paid $6,000, and it's a $20,000 spread basically. It has more upside potential because it's not fully capped either. But since we have 10 of these are uncovered, then we could sell 20 of the $20 calls, and we're collecting $150. That's $3,000 in premium against a $6,000 net position. 50% of the position we're collecting in a 3-month period. It's 50% return on our money in 3 months of pure premium sales. Now, maybe they'll go up. So they're 19 now. Maybe they go up 20% to 23. I will owe these guys $3 back at 23, right? That's what I mean. The premium evaporates, and all they get back is the $3 that it is. So if it's a 23, I owe them, I'll have to pay them $6,000 back. Now, we wouldn't pay them $6,000 back. We would roll the short calls to a higher strike, and we keep rolling, whatever. But let's say I even paid them back the money. If I pay them back the money, this spread is 100% in the money for $20,000. Currently, the spread is valued at $10,000. If it goes up, and I can actually tell you because the calls, which were what? Oh, this isn't even Best Buy. Bed Bath & Beyond, not Best Buy. BBBY. So annoying. The 2020, shit, what were they? I can't remember. The $15 calls. Okay, have a 74 delta. So if it goes up, if the stock goes up $4, then 0.75 of $4 is $3. So these things will gain $3 in strike. Times 30 is $9,000. So the long calls will gain $9,000. Now, I have only sold 20 of the short 2250s. They have a 44 delta. So in other words, so if the thing moves $4, they'll gain barely $2 in strike times 4,000. So I will subtract, I'm sorry, $2 strike times 20 is 2,000. So I'll lose 2,000 on those short calls, but we'll make 9,000 on the long, so we'll go plus 5,000. So if I have to pay $3,000 to the short caller, that would only be because I made a net of $5,000 on the long spread. I don't have a problem with that. I'm still up $2,000 overall. But that's my quote worst case to the upside is I make another $2,000. To the downside, it's brilliant because we collected $3,000 against our long position. Still have the long position, sold the short calls, and we can do it again, make another $3,000. Okay, so selling premium is like an intelligent business to run. You make money with every transaction. You make a new transaction, you make some more money. You make another transaction, you make some more money. When you're in a business and you're selling things, you don't sell things that might come back and bite you in the ass. You don't sell things that are going to hurt you. You sell things that are good. You sell good products and make you money. And good products that make us money is short premium sales. You know, we intelligently cover it, so there's a very little chance of us getting hurt by the positions. And it's more like a casino than a retail store, because in a casino, yeah, of course you're going to lose sometimes. Obviously, on any single roll, if a bunch of people bet on 11 and 11 comes up on the wheel, you're paying 35 to 1 to a bunch of people on 11, you lost money. Something weird happened. They caught on, they got a match. Now, a lot of times there's so much money else on the table getting lost that it wipes out the amount that you're giving. That's like when you watch roulette people, they move the money around the chips first and basically it evens out. You know, like they pay off the people who they take more money away from them than they put on the table when they start pulling the chips off the table. So like they pay this one guy, they put the market down on all the other chips they take, and then they pay the guy. So what you're doing is getting everybody else's chips anyway. But sometimes somebody gets lucky, they win a big pile of cash, whatever. They don't care at a casino because they know that statistically they're going to win over time. Just keep playing. And if that big winners try to leave the casino, what do? They invite you back. They give you a suite. They buy you drinks. They send you to a show. They give you a plane. Whatever it takes to get you back to the table, they'll do it. Because you've got their money and they get it back by having you play some more. And with options, we can always find someone to play, and we don't have to buy them a drink, and we don't have to own a whole casino, and we don't have to have interesting games. Our only game is saying, hey, we're willing to sell. If you want to bet that Bed Bath & Beyond is going to be over $20, it's 19 now, you want to bet it's going to be $20 in January, then for $1.50, we will give you that bet. Now, how much does Bed Bath & Beyond? How much does Bed Bath & Beyond have to be for him to just get his $1.50 back? That's be $21.50 just for him to get his money back. That's 15% higher than it is now. That is an idiotic bet. That's a bet made by a moron. Yet we can take his money legally. It's mean, but we can do it. And the 1750 put, same thing. Somebody's willing to pay $1, then it won't go to 1750. That's a good sale too. But that's what these bets are based on. They're based on the probability that we'll make money, and we'll make money in short order between now and Christmas. Where were we? Oh, yeah. So that's Bed Bath & Beyond. Cheesecake Factory, another one I really like. It was on our watch list. Most of these trades come off our watch list, by the way. Whenever I'm looking for trades, I look on our watch list to see like what hasn't popped yet or what's in a good position. Because we look at our watch list companies all the time, so we study them and we know what their habits are basically. And we have a pretty good idea where they're supposed to be going. So Cheesecake Factory, I don't think it's going to really go anywhere, so I wanted to collect some cash for the $55 calls from the people who do think it's going somewhere. So we took a new trade. We're selling the puts, $45 puts way down here, 45, and we're selling for $5. So really way down here. That's where we get in trouble if it goes way the hell down here. More than 20, like almost 25% off the current price. We're buying the 45, again, way down here, 60, right to the top of where it's been zone, the 45-60 bull call spreads. And that's a $15 spread that we're buying for less than $7. It's got 100% upside on the spread by itself. And we're selling 15 of the 55 calls. So we have 25 longs and the short puts, and we're selling 15 of the calls for $285. So if we sell the 55 calls for $285, that's $58.55 or $58.85. So up here, $59. So it has to be higher than this before we even give the person their money back. And if it's that high, then our spread is practically 100% in the money. So I'm happy to give the guy his money back if we're 100% in the money. I don't care. I don't need his money because I got mine coming. But if not, and if it expires worthless, or even if it doesn't have to be worthless, even if it loses half the money, even if we have to pay them back $185 and we get $1 is still $1,500. And we're paying 17 minus 53 is 11.7. So we're paying 11.7 for the spread. And in the first quarter, we're selling 42 of that. So that's like 60%. We're collecting 60% of the cost of the spread. No, 60%. What am I talking about? 11.74. So it's about 30 something, 35% of the cost of the spread in the first attempt. But even if we don't get 30% a quarter, and we only get 10% per quarter back, we still have 8 quarters to sell. And if we get 10% of our money back 8 times, that's 80% of our money back. We still have the long position. It's hard to see how you can lose on a trade like this. And those are the only kind of trades you should be in a long-term portfolio. And you shouldn't be messing around with short-term trades unless you have a long-term portfolio full of this stuff. Unless you have intelligent investments backing up your portfolios, you shouldn't be screwing around with short-term bullshit. The long-term portfolio that we have is up 80% in 1 year. It's our first year. It hasn't even matured yet. And it's just doing stuff like this. But when you have a bullish market, the positions take care of themselves. You don't make more money by betting short-term. Well, we did in our short-term portfolio, but normally you don't make more money betting short-term than you're going to make if you have these leveraged long positions. And it's only taken us 1 year to establish an incredibly powerful portfolio. That's why we're able to add all these trades now. We're swimming in cash. We have tons of margin available. We can do all this stuff. So it's a shame not to. I can make $100,000 in the next 3 months on these 9 positions. And I just sent this out as a top trade alert today. So we're going to see at the end of in January, we'll do a review. I'll do a special review on these, and we'll see how they finish up in January. But I'm looking to make $100,000 on 9 positions. So even if it's a brand new portfolio from scratch, this is a great portfolio. And all it is what we're adding to the long-term portfolio for the quarter. Now here's Chipotle. We have Chipotle, and I'm putting this one in because I want to make sure in case somebody doesn't have it. This position is one of the cornerstones of the long-term portfolio. We're counting on this thing to make us like $100,000 next year. But what I liked about it, what caught my attention, because I was looking at Chipotle and I said, oh, we already have it. So we're already doing what I consider ideal for the position. Is we have the 460 580 bull call spread in 2020. That is currently $90,000, right? Plus. It's $120,000 spread. No, I'm sorry, it's $240,000 spread. So it's actually still a kick-ass spread, although it's only at the money. It's 460, so we're right at the money, 580. I don't really believe Chipotle is going to go to 580. The reason we have this position is because we had a much deeper position that we already cashed out. So we rebuilt a new position. This was the top of our old position. The 460s were the old top of the spread. So we originally had, I don't know what it was. I think it was like a 350, 460 spread or something like that. And when it got to here, here's what we did. We cashed in, maybe it was 320, 460, I don't remember exactly. But when Chipotle went nuts and went flying up, we cashed the 320s, took all that money off the table and the premium because we knew the premium was going to wear down over time. So we cashed it in while it still had a lot of premium, and we left the 460s that we had sold in, well, that says August, so I guess this was a second sale. So we left the 460s because you see here, August what, 27th. So here, August 27th is around here. We sold the 460s when it was up around 500. We got 60 bucks for them. They're down to 37 already. But 37 is still $74,000, and we're at 468. So it's a new sale. It's still pretty damn good, right? And net on this spread, you're paying 90. Let's call that 90 minus 75 is about 15,000. The net of the spread is $15,000, but you have 20 $120 spreads. So for $15,000, you don't think of it as saying, I think that Chipotle is going to go from 460 to 580. What I think is I have a hedge that's going to allow me to sell $75,000. I wouldn't sell every quarter, but it's not, up to $75,000 a quarter of short calls. Now, obviously, if this pays off and I was doing it in a vacuum, I would probably do less than 20. I would probably do 5, in fact. But 5 of these things is still $20,000 a quarter against a $15,000 hedge. And I made a note here, say, look, if you're doing this, you have to have lots of margin, number one. Number two, you have to be willing to double up. If Chipotle, for some reason, flies back to 550, then we owe the 460 caller 100 bucks. Okay, he paid his 60, we're still down 40. We'd be down $40,000. Now, this position would be in fantastic shape, and it wouldn't be tragic, but still it would be ugly as far as the way it looks because there'd still be a lot of premium here. We wouldn't look like we have a big profit, and this would show a very large loss. So then we would probably double down on the spread here while it was still cheap, and then roll the calls to a 2x position. All right. We don't do this in a vacuum. We do this because we know Chipotle. We've been playing it all year. We know what it's worth, and it isn't worth 550 bucks. If it goes to 550, it's wrong, and we will then act accordingly. And something can be wrong, like those crazy pot stocks or things that move like for no reason, or Tesla or something like that. Something can be wrong and not fix itself because it's not big enough to fix itself, or something can be wrong like Chipotle, which is really a freaking fast food franchise, and it just simply is not going to trade at 3 times the value of McDonald's. And I mean value as in per dollar earned and so on and so forth. There's no justification for it. They don't have the growth. They're not showing any kind of major movement. The growth that they have is due to good comps coming off the bad quarters they had when they were poisoning people. So last year they were poisoning people. They had really terrible numbers. They're showing very good growth in profits compared to last year, but last year was terrible. So there's no reason for them to keep going higher. They're not going to beat these numbers. They're not going to continue growing at this rate. They're going to disappoint people with the upcoming earnings. So I'm betting bearish on it. And betting bearish doesn't seem bearish because we have a 465.80 spread, but that's not what I'm really betting. This is only covering the possibility that these 460 calls might go into the money. If they do, I want to be covered. If they don't, then we're great because these things will still hold some value, and this will make us 74,000 bucks. And again, that's just one sale out of 4 more ahead of us on these. But of course, we're going to roll that to the 2021s and do it again eventually too. And we haven't even sold puts yet. It should probably have to get back to 300 or 350 before I'm going to sell any puts. Because I would not be at all surprised to see him back at that price. Oh, Fed's up in a few minutes. Oh, well, we're not going to get to all these. David says, speaking of GE, I didn't get filled the short $15 calls at 150. Should I just be holding the naked long calls? There shouldn't be naked long calls. There's a spread. Let me see. Where did GE come up? GE. So I said the 2021 10-15 bull call spread is now 190. The $15 puts clearly on. Wait, I didn't get filled a short 15. You mean on this spread, you have the $10 calls and you couldn't sell the $15 calls. Is that what you're saying? So I don't get the 150. They're not 150 now, so you must have bought the 10s a while ago and never filled it. That's the only thing I can think of. Because the 15s are nowhere near $1.50. So you have the 10s, I imagine, of not 2021, you have 2020. So you have the 2020 10s, which are now 230, and you were trying to get 150 for the short. I don't know. I'm not sure. I can only imagine it would have to be in 2021 for this to even be a statement. I don't know, because unfortunately already lost money. I wouldn't cover. Yeah, I wouldn't rush to cover it. I would hold out. I just think GE is ridiculously low right now. So, but unfortunately, if the whole market tanks, GE is going to go down too. So it's a little bit tricky. You know, when you do these fills, you really want to fill like a half or a third or a quarter of what you want, and then once you fill that, go to the next quarter. Don't, you know, if you're buying 20 $10 calls and selling 20 $15 calls, you don't want to buy 20 $10 calls without having sold any other calls. That's a terrible idea. You want to sell you want to buy 5 $10 calls, and then once you fill the 5 $15 short calls, then you go to buy the next $10 calls. That's the way you do it. You try to do it in some kind of sequence that makes sense. And you can use the intraday momentum when you're doing that, obviously. If you think it's going up, you buy your calls, long calls first, and wait to sell the short calls. And if you think it's going down, you can sell some short calls first and buy long calls. And if you do it in small increments, you have control over that. You can afford to do it. But if you do it all at once and blast it, and then you don't get your price on the other one, exactly what happened to you will happen. The money can get away from you really fast. But at this point, after this drastic downturn, I don't think I'd really jump to take loss. It's not drastic. I mean, you'd still get 110 probably. If you hold out, you can get 110. But 40 cents is a lot on a spread like that. So I would prefer not to. But if it goes below, if you start seeing a 90 handle here, like a 95 here, I would probably take the 95 and be done with it. You don't want to get nothing. You don't want to get nothing, then you'd be totally screwed. Fed. Right. Okay. So FOMC. Statement. Dun, 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 dun. Who is this now? No, it's not now. It's this one. Fed decision moments away. Newscasters freaking out. La da da. Let's see what the guy says. Hang on. So where are the indexes? Where's the dollar? There's no dollar chart here. Replace coffee with the dollar. So the dollar came down a bit today from 94. GE, what is going on here? Didn't we change that already? All right, so, oof. I like that NASDAQ short. Wow, oil's coming down nicely. Brent's coming back towards 80. Gasoline back to 205. Natural gas, big plunge. Testing $3. Here it is. Raising. Oh, they did exactly what they said they'd do. That's funny. Let's take a look. Wait, how can I split screen this? Hold on. This is too funny. They did exactly what they said they would do. Shoot. Ah, where is it? Post. Not doing much for the market. Oh. Okay, so here's the actual thing. All right, they got that right, September 26th. They got that right, August. That wasn't hard. Now, what is this bullshit? The committee expects further gradual increases. See, I knew they wouldn't say for now. In the target range. See, I was right. All right. He has nothing to say to this guy. Oh. All right. So looks like 3 rate hikes for next year, apparently. Okay. The committee decided to raise the target range. Very good. Funds rate 2.25%. Yes, correct. Stance. Okay, what's it say? Wait. This is confusing. They don't say the stance. 2.25%. And now it says something different. Oh, wow, they skipped all this. They cut this whole thing out. The stance of, they just erased this entire thing about labor market conditions. They refused, they don't mention labor, they took it out. And then they left this paragraph the same. So they took out this whole sentence about the stance of monetary policy does not remain accommodative anymore. It doesn't support a strong labor market conditions. That's interesting. Or return to 2% inflation. Though it does down here talk about inflation. But that's kind of funny. They stopped talking about the inflation and job targets. Very interesting. All right. So basically, though, I have to give these guys credit. They totally nailed it. This is almost exactly what they said the Fed would say. But therefore, there's not going to be a lot of effect from the Fed, theoretically. Because there's no news here. They're just doing what they said they would do. Now, economic activity rising at a strong rate. Let's see if we can find their economic forecast. Where is that? Be projection materials. That's going to be it. Oh yeah, there we go. Oh, I knew it. Look, 1.8. Oh, it's going down. Unemployment rate going up. Wow, they are. This is not good, guys. All right, so unemployment rate 3.7, long run 4.5. So there's no 3% GDP growth for Trump. Not in his entire presidency is it projected. That means his whole budget is completely blown. You know, when he projects it's going to be 4%, and it's really 2.5%, and it goes down to 2%. It's not just the 1 year that's affected. In other words, he's not going to hit 4% this year. He's barely going to hit 3% this year. Next year is below 3%, not 4%. The next year is below 3%, not 4%. So it's really, he's missing by 400 billion 1 year, but then the 400 billion isn't growing by 4% either. So he's missing by 400 billion, 500 billion, and the next year he's missing by 600 billion. He's going to miss by about $1.5 trillion. And that means if he's blowing his estimates on GDP, That means his budget is being blown by $1.5 trillion over the next 4 years or 3 years. 1.5 trillion, 500 billion a year average mess by Trump. And we will be $25 trillion in debt or $26 trillion in debt by the end of his presidency. And rates will be 4%. And if rates, by the way, are 4% and we're 26 trillion in debt, that means that we owe $1 trillion per year in interest on the debt. That means interest on the debt will be as large as Social Security payments. And there's no budget for that whatsoever. So I don't see anything bullish in something like that. PCE inflation, like I said, the Fed's not going to say anything about it going up. Core PCE, nothing changing there. Fed funds rate, they're saying lower numbers. They're saying 2.4, 3.4. So 3.4 is better than 4%, but I think circumstances are going to push that higher too. But so they're not looking for many hikes here. They're going to be hiking up to 3.1 next year, which is not very high, and then 3.4 in 2020. So they're looking to maintain a very, very low rate. But here's the Trump presidency. We were rocketing up, and then Trump takes office, and the momentum slows and reverses like that. Unemployment, we were heading down sharply, slows and reverses. So, inflation is basically where it's supposed to be. Well, the Fed's trying to make inflation. So they're looking at 3.5. They're not looking at 4. They're saying we're not actually going to get to 4. That's what the Fed's basically saying in this statement here. They're saying this is more likely to stay around 3.5. And then there's this other bullshit. Okay, great. Well, that's fun. So meanwhile, now let's see what we can do. Wow, look at the NASDAQ. Oh, yeah, I would like to short that. Let's see. Yeah, I'm going to short that. Let's go to the NASDAQ. So on the NASDAQ, I think below 76.50, I don't mind shorting. Wait, where is it? Come on. Come on. It's so far up. It's not on the chart here. There we go. Found it. Wow. All right, I'm going to go 1. 76.50 is a good place to start. What the hell happened? I would sure want to see what happens. I think it's bullshit. I think the spike is a wrong call. There's nothing bullish about what just happened there. John says, wow, they were accommodative with a 0.25% Fed funds rate raise, and they upped their GDP estimate from 2.8 to 3.1%. So you think that was a good thing? I don't think. I mean, the GDP estimate, they've been putting much higher numbers on it. The Atlanta Fed was talking 4 point something. So what they're basically saying is that the Atlanta Fed GDP now. So the Atlanta Fed's GDP now is currently showing 4.4% basically rate. That's where they're at. So when they're saying that for the rest of the time we're below 3, it's saying that this particular quarter is nothing but a blip, and you can't read into this. But the market is pricing this in as if it's a continual thing that's going to keep going. Now, by the way, the Atlanta Fed, I don't know where they get these numbers, because they're saying existing home sales are going to be rocketing up. I don't see that. I mean, we just got some terrible home sale prices, home sale numbers, so I don't know where they're getting that from. Manufacturing, so-so. Personal income and outlays, I guess so, because they don't subtract debt from that, which is a big mistake, because the debt's going up real fast. The employment is stable. It's not getting much better, so I'm not sure what they're looking at there. Wholesale trade, so-so. Producer prices are flat enough. CPI flat enough. And the housing starts are trailing off too. So there's a couple of things here. I don't know what they're looking at because I'm not seeing it in the reports that we've been looking. Oh, look, we're pulling back already. How nice. There you go. There's a quick 85 bucks. That wasn't hard, was it? See, it's not hard to make money in the market. Just pay attention. So speaking of making money, we should go back to our thing because this is not going to be very exciting. Check on it later. What were we doing? Oh yeah, right. So we had this thing. And what were we up to? Did we talk about Chipotle? Cake, Best Buy? I lost track. Where did we leave off? We talked about Chipotle, right? And Gannett was where we left off. Okay. So Gannett's another Q1. It's a newspaper, you know, it's USA Today and a bunch of other little papers and stuff. And again, what I was attracted to is I was looking for things where we could sell some, you know, collect some cash between now and the holidays by selling premium. Because that's our job. That's what our business is. We're in the business of selling premium. So here we're taking a position, the 10-12.50 spread, 10 to 12.50. It's quite a bullish sort of thing here. We're selling $10 puts for $1. So we're basically saying we're paying net 9. So we're in here for net 9. The spread is a $1,500 credit. So even if it gets assigned to us at 9, we're really going to pay about $9.50. We'll get a 50 cent per long credit net. So we'll end up being in at $9.50. I don't mind being in at $9.50 because why? Because I can sell these freaking April puts. I can sell puts that are 5-6 months out for $1. So I can collect $1, 20% every 6 months on against my position. So do I think, you know, unless I think Gannett newspapers is going to go bust in the next 4 years, I'm going to get most of my money back. So my worst case scenario is I just end up owning the stock and keep collecting these huge, it's not a dividend, I'm thinking collecting an options dividend by selling options. So my worst case scenario is not bad. And my best case scenario is making a lot of money if we spike back up into the 12s. Meanwhile, though, every few months we'll be able to sell these, you know, pull up another $22.50 in income. It's a $1,500 credit, so $22.50 in income is more. I didn't lay anything out. I collected $1,500 to get into the trade. So the nice thing about this is between now, this is a very modest trade. Between now and January, we're going to drop $1,500 plus $22.50 into our pocket. So if it does go down, I keep $37.50. And then we just wait and see what happens with the rest of the trade. So $37.50 is good money for a few months. Gilead. Very nice and rangy, so rangy that I'm going to consider this for the butterfly portfolio because this is a beautiful thing. It's volatile, but it stays in the range overall. So we have 5 short puts, and we're going to buy those out. And that means this is basically a new trade. So we made $1,000 on these, and now we're saying, okay, we're going to take up a more long-term position. And again, what attracts me to this? Because we can sell the January 77.50 calls. 77.50 is up here. We sell this for $330, collect $5,000 basically on that. How much is the spread costing us? The spread is going to be, we're selling the puts for $12,000, we're buying the spreads for $17,000, so $5,500 spread, and we're collecting $5,000 in our first sale. And we got 25 of the spread, so we're not even fully covering here. And what spread is it? The 65, deep in the money, 85, covering the range, bull call spread. 25 of those is the $37,500 spread. What are we paying for it? $550. We're paying $550 for a $37,500 spread. That's like 70-something times upside. And not only that, but every quarter we can sell some calls. Now, we might not always feel so brave as to sell 15 calls, even though it's only a 60% coverage here. But if we sell 10 calls, that's always going to be easy to do. And if we sell 10 calls for $330 and we make $3,000 a quarter in premium, 8 times selling all the 2020s and all the 2021s, it doesn't. I'm sorry, all the 2019s and all the 2020s, it doesn't expire until January 2021. So we get to sell 8 times, 3,000 is another $24,000 of premium sale. So you're looking at a $50,000 to $60,000 potential upside for a $550 net investment. All right, now will you stop messing around with short-term trades? Will you stop bullshitting with trades that you don't sell premium on? I really don't know what else I can say or show you. And that's where this is coming from, because people keep talking that, you know, it hasn't been a great environment to buy things. So I have to knock myself out looking for like some good trade setups. Because for like 2 weeks, we haven't done too much trading. And it's just not a good environment. It's very toppy. So the only things I'm comfortable with are things that are going to generate a lot of income. So no matter what happens, we have an income to fall back on. And I want trades that have tremendous upsides, because these tremendous upsides will protect you from a lot of problems down the road. But look at the power of a trade like this. $550, the spread alone is $37,500, and the potential for call sales is another $24,000. That's $60,000. If you can turn $500 into $60,000 in 2 years, what else should you be doing? And I know it's boring, because all we ever do is once a quarter we go, okay, time to move these calls. You know, we'll take the short calls here and we'll roll them, we'll pay them off or whatever we have to do, and we move them. And the next quarter we do it again. It's boring. It's a nice boring way to make hundreds of times back on your money. I mean, I don't know what else I can show you. Or hundreds of percent, not hundreds of times. But you know, it's like you know, there's nothing that beats this kind of stuff. And as long as you can ride out a move against you, like let's say they have a bad drug trial or something like that and they go down. Now, the worst thing that can happen, somebody buys Gilead for $100. Because then these calls would be worth $22.50, right? And we'd be down $20 each, so we'd be down $30,000. Is that right? 20 times 1,500. That's 30,000. Yeah, we'd be down 30,000 here. But even if we're down 30,000 here, it's a $37,500 spread. So we'd still make $7,500, even if they get bought for $100. Even if something crazy like that happens, that'd be 33% higher than the current price. It's hard for us to get hurt here. Can we get hurt to the downside? Yeah, that's where you can get hurt. But as long as you don't mind owning the stock, because we're selling 15 puts at $67.50. So I don't know what that works out to, but it's whatever it is. It's about $100,000, I think. Am I crazy? Sounds right. Times 67.50. What? That was divided. 1,500 times 67.5. $100,000. There you go. Okay. Seems like a lot. Anyway, so it's $100,000. So if you have a $500,000 portfolio that has $1 million of buying power, and we now have a $1 million portfolio, so we've doubled our long-term portfolio. So we've got tons of buying power. We can afford this. All we end up doing is owning $100,000 worth of Gilead, which should, in theory, take $50,000 worth of our margin. And then we would work on it. But we would end up owning $100,000 worth of Gilead. We only paid $550 for the spread, so it doesn't cost us more than the $100,000 we spent. We're in the stock for $67.50 if it gets assigned to us. And that's not even including the fact that we have 8 different times that we can sell short calls in between. So even if it is going down like that, we can still pick up the $24,000 of short call sales. And then we'd be in it for $75,000 on 1,500 shares, which would be $50 a share net. $50 a share is down here. That's our worst case. Our worst case to the upside is we still make well, not the worst case, it can go to 500, but and the worst realistic case, they get bought at 100 and we still make 7,000. The worst case to the downside is we're in the stock for a net of roughly, net of roughly 50 a share, somewhere between 60 and 50 a share. Those are our worst cases. Our best case is we make 60,000 frickin' dollars. It's a blue chip pharmaceutical company that makes a fortune. It's like, why would you frickin' play with Netflix or Amazon or any of these bullshit stocks when you have perfectly valid plays like this that you could be making? It's very frustrating from my standpoint. I try to teach this stuff and people still make ridiculous trades. There's no need for it. Uh-oh, NQ had it up, somebody said. Really? Oh man, I'm getting burned. Should take my $100. Where are we? Yep, down 200. Let's see, what do we got here? Oh, we got the wrong thing, so I gotta look at the right indicators. So we got YM, and let's put the NASDAQ over here, NQ, put them in the right places, otherwise I get confused. And this is ES. I'm willing to go with another one over here. So now my average is 765,475. Wow, look at that, spiky, nice. All right, so now let's look at the dollar and see if the dollar is causing any of that, DX. Yeah, so the dollar sharply spiked down, which is probably what drove the indexes up, but it's recovering a bit, so we'll see what happens. I don't see this as a bullish thing. I really don't. So my average is now down here, so hopefully we can get out. Hopefully I can get back to 1 when I'm even, but we'll see what happens. And it goes higher. All right, so that's Gilead. GoPro. GoPro is one I've been saying for a long time. I thought was underpriced, and so we had the short puts already. So a long time ago, we sold the 2020 $8 puts for $3.75. That nets us in for $4.25. So we were netting in at $4.25 when we took that position, which was where? Long-term portfolio, okay. Page down. Oh, there it is. So back on 1.9 is one of our first positions. We sold 20 of the GoPro 2020 $8 puts for $3.75, and they're now $2.04. And so now, finally, after 8 months, we're finally going to turn it into a full position. And the full position we're taking is we're going to add 40 of the 5-10 spreads. Okay, so we collected $7,500 on these, right? Is that what it says? Yeah, we collected $7,500 on the short puts. And by the way, so when we do this, our net, like I said, our net entry is 425. So the worst thing that happens is we own $8,500 worth of GoPro. So I'm like, that was a no-brainer to me. That's why it was one of our first positions in the portfolio. I'm like, why would I not want to own GoPro at 425? It doesn't make any sense. It's like, it's a valid, known brand of stuff. Even if they have to retool themselves, whatever, it's still worth something. The 425 seemed like a great deal. So I was like, okay, we'll do that. And we'll pick up $7,500 cash for doing it. So that $7,500 is now part of this trade. So we're buying 40 of the 2021 510 spreads, 510 spreads for $190, and that's only $7,600. So it's net $100 that we're spending on the trade in total now, because we have the short puts that are looking pretty good now. And we're also now, again, we were looking for incomes. Doesn't seem like much, but we're going to sell 20, half covered, of the January $8 calls. Eight's way up here. Well, it's looking a little sketchy right now, but we're going to sell the $8 calls for 50 cents or 45. So then we're going to collect $900. And again, we're in the 2021 spread. We have 8 more of these to go. And 8 times 9, I believe, is 72. So we're looking at collecting $7,200 going forward against a spread that cost us $1,000. Did we spend $1,000? No, I did the math wrong. I added the $900. I should have subtracted. It's actually an $800 credit. So we're in a $20,000 spread with an $800 credit, and we have 8 more quarters to sell. So we can collect against our $800 credit. We collect another $7,200. So let's say that's $8,000. So we could have an $8,000 credit, which is twice as much money as we could possibly be assigned if it gets assigned to us. Oh no, I'm sorry, not twice as much, the same. So basically, so that would make our worst case now, that we end up getting the GoPro for free, the stock, if it gets assigned to us down the road. So we'll just keep selling calls, keep collecting $900. And obviously, if the stock is going down, the short calls keep expiring worthless, and we get our $7,200. So we can collect 70. We have an $800 credit. We collect another $7,200 is $8,000, and the spread's $20,000. So we can end up with $28,000 off an $800 credit. This is the way we like to build a portfolio. This is how we like to run it. And by the way, very important, you don't cover every spread and do this with every spread. We have a lot of positions in the long-term portfolio that are simply bull call spreads with short puts. So they're generally essentially bullish positions, and we did not cover them with short calls. Why? Because we feel they are low enough in the channel where we think the growth is more likely and we don't want to get burned. So you don't always all the time sell short calls. In these positions, in this particular quarter, I like selling the short calls. In another quarter, I might like selling different short calls. But either way, if I can sell $100,000 worth of short calls per quarter in a $900,000 portfolio, that's $400,000. So that's a 45% return on my $900,000 just doing this. That's not even talking about the portfolio growth. That's my bonus buffer money I make selling premium. This is why being the house is so effective. But you've got to balance your portfolio out. You can't sell short calls against every position you have, because in a major market move up, you can get pretty badly burned. So you have to think about it with each position. And as we talked about last week, you've got to be very well balanced in your portfolio. You don't want to overdo one sector or another, because if there's M&A in a certain sector, the whole sector can rocket up and all your short calls get burned in the same sector. So it's the same thing, the same way you want to distribute and have lots of different sectors and not too many companies in the same basket. You also don't want to sell too many short calls in the same basket, or have too many short puts in the same basket. It all goes together. You got to always think of the whole portfolio and the balance of it and how much risk you have. So so you say, well, what if the market rockets up and all these things get higher? Well, that's good, because I have plenty of uncovered positions that are going to make hundreds of thousands of dollars if the market rockets up. So in addition to the self-hedging I have within the position, I also have hedges, as in I've got a whole portfolio full of stuff that makes a fortune. In fact, we demonstrated all year long, it makes a fortune when the market keeps going up. And it's going to keep making a fortune, because the positions we have left in the long-term portfolio are basically newer positions. They're either newer positions or they're older underperforming positions that we've left in. So if those underperformers start performing, the portfolio could double again next year. Macy's been all, I always like Macy's, but it just got too expensive. Now it's come back a bit. Now, again, not a super bullish position. We're taking the 30-40 bull call spread, 30-40 bull call spread, 15 of them. We're 3/4 covering it with the 35 calls, 35 being right where it is now. And what are we doing? We're getting a $1,950 credit to start, and we collected $2,700 that first quarter. 8 times $2,700 is like $20,000. So against our $1,950 credit, we can collect $20,000 over the next 2 years, and it's a $15,000 spread if it goes in the money. That's $35,000 back on a $1,950 credit. Do you notice that we can do this over and over again? You can have a whole portfolio of things that are going to go up 20 times if all goes well. And they're hedged. And not only that, we're not even playing for a bull market. We're playing for a flat market mostly. We're thrilled if it's flat. We're thrilled if it goes up a bit. The only thing that really hurts us if it goes up crazy or if it goes down crazy. Anything other than down crazy or up crazy, we're going to make money. And quite a lot of it. PSA, we watched them. We were watching them from the beginning of the year in the on our buy list, and it never got back to 200. It finally got back to 200. So I'm like, okay, well, let's just sell 5. This is just a normal long-term portfolio thing. We're going to sell 5. This isn't really one of the ones that's obviously going to pay off by January. But we're going to sell 5. The 2021s came out and it hit 200. I don't want to pass that deal up. I expect it to have support. Here's the line to 200. I expect to have support there and come back. So while it's on the way down, the puts are probably high in price, and we can get 24 bucks for the put. So that's really net 176, which is way down here. So below the low for the year would be our net entry, and that's all we're doing. But just that little thing, selling 5 of those puts is 12,000 bucks and drops into the portfolio. Target also top. What I think they're toppy. I don't think they're going to go to 100. So if they're not going to go to 100, that means it's good for me to sell calls. So we can sell the January 85 calls. In fact, I'm even betting they're going to go a little bit lower. But they're 620. That's so much money. How could you not want to sell the 85 calls for 620? So we sell those. We collect 6,200 bucks. We take a spread to cover the short calls. The 80, which is lower than the 85s. The 80-95 spread. So covering from here to here. And we're selling the 85 calls for 620. So the only way that we're going to lose, because we have the 80-95 spread. At 95, we get $15,000 back here, and we have to pay these guys $10,000. But our net entry was $800. So we would still be up 5,000 bucks or $4,200, even if it hits 95. But if it hits 95, we're not going to just pay these guys back. We're going to roll them to the next puts, and that's important. Let's take a look at that. Target January 85. So what is this? How do I make that go away? No. Oh, maybe I make the whole thing go away. There you go. All right. So target, the January 85 calls are 640. So if you want to figure out a roll, all you got to do is look to a longer thing and see what you can roll to. So in April, what else? So what you really want to do is a rule of thumb. It's not an exact science, but if these are 625, what's 625 in April? And in April, the 8750. So you can roll up 250 into April. Into January of next year, you can roll up to, here you go, the 9750s. So if we get burned on the 85 short calls, we can roll them up $12.50 per year. So target has to be, and we have 2 years to roll. So target has to be $25 over 85. It has to be $110 before we run into any serious trouble. And not only that, but we've got no, I'm sorry. In this position, we have 10 longs. But what would we do if target does break up over 90? If it breaks out of this channel, in fact, we would double down on the longs, and that way this would have less impact, and would also then allow us to split. And if we split the 10 into 20, we could then look for who's at $3 and how high can it go, and then $3 is the 110 calls. So we could go all the way up to 110 by 2020. That's a $25 move. That means that by 2021, we can go up $50. So we'd be at 135 before we would have to pay these callers back, the short callers. And interestingly, because we doubled down to make that happen, we would have our spread would be totally in the money for, I think it's a, nope, I don't remember. It's a, for $30,000. So we'd be $30,000 in the money anyway. So that means it would have to be another $30 over 135. So target would have to be 165. It would have to be up 100% in 2 years before we're going to probably lose money on this trade. So that, and again, you got to like the odds. And that's what we're playing it for. Playing it for the statistics. What is Target going to get bought out for 100% more than it is now? No, it's probably not. Who would buy Target for 100% over the current price? Do they deserve to be up as far as they are? They're up 20% from where they were earlier in the year. No, that's it's a bit overdone. So we're betting it to go down on the next earnings. That's all. And if it goes up instead of down, we roll the short calls. We got the long calls to fall back on. We'll be fine. THC was also Tenet Healthcare. One of the first things we bought this year. I think we bought them right here. We like nailed it. I think that's us buying it. I think that volume spike. We bought it right here, and when they rocketed it up here, we sold them over here when did all this stuff. In fact, that's us selling right here. Or maybe, well, no, we were before that. We sold somewhere around here or here, one of these spikes. We took the money early. It was just way too much money, way too soon. We had only bet it to go to 25. It was crazy. So we took it off the table. Now it's finally pulled back. Now, obviously not. It's never going to pull back to where it was because it was a stupidly low price. But it's pulled back enough. And again, it's attractive because we can sell 10 calls for $3,000 for January 28th, where it is now. And we can buy, we're selling 23 puts for $550, so that's net 18, which is way down here. And we're buying 15 of the 2750, 37. Now, again, it's not because we're super bullish, it's because we're just covering the calls as cheaply as possible. But this $6,000 here, forget the puts, but this $6,000 here is allowing us to sell $3,000 a quarter. If I sell $3,000 for 8 quarters, $24,000 paid back on $6,000. But because of the puts, we're only netting in for $500. And because of the puts and these, we're getting a credit of $3,500. We're getting a credit of $3,500 credit. That's wrong too. Boy, that's doing bad math. This is 6,000 minus 55 is $500. Less 3,000 more is minus $2,500 credit, not 35. So it's a $2,500 credit, but it's $15,000 spread. But it's not even about the spread because it's not the spread where I expect to make the bulk of our money. I expect to make the bulk of our money selling quarterly options, selling premium. That's our job, sell premium, then sell more premium, and then turn around, find some more premium to sell that. That's our system. It's not complicated. That's how we built a portfolio that made 80% this year already. Just doing this stupid trade like this that look like long-term bullshit trades that you're like, oh, that's so boring. It doesn't matter if it's boring if it works. It's exciting to get the money in your portfolio. Making money is exciting. You know, most of you guys, you didn't get into trading. If you got into trading because you got the gambling high from trading, you're in trading for the wrong reason. It's a terrible way to gamble. But if you're an investor and you got into stocks for investing, don't get confused and start gambling. Investing is a long-term process. You build wealth over time. I say this often at these webinars. You know, you look on the Forbes 400 list of the richest people, and you see people who are long-term investors, not traders. You see, you know, people who invest, people who are financial guys are Warren Buffett and things like that. They're not going to be, you know, like Jamie Dimon and what's his face from Goldman Sachs, Blankfein. You know, you see a lot more guys like that than the guys like Soros, who's a trader. He does exciting trades. Icon, Icon doesn't. I'm sorry, I wouldn't put Icon in that class. And frankly, Soros isn't either, because Soros is he's a financial bully. He makes a trade, but he makes a trade where he's able to force the situation. So, you know, you say, oh, George Soros bet the euro to do this and that. Yeah, he bet the euro to do this and that, but then he pushed a ballot initiative to change something that made the euro go up. He didn't just make the euro go up. He said, I see a way where I can make the euro go higher, so I'm going to bet the euro to go higher, and then I'm going to cause the euro to go higher. So Soros is a manipulator of global events and a manipulator of the markets. Icon also. Icon is a manipulator of corporate events. So you might classify them as traders, but they're not traders. Carl Icon's not sitting around the screen buying calls. He doesn't do that. Carl Icon buys a stock, shorts a stock, but then he agitates the company to move in a certain direction. That's how these guys work. We were talking about HCB earlier. HBC, sorry. Wait a minute. Wasn't it today we were talking about that? Oh no, UBS, that's right, sorry. Getting my banks mixed up. So UBS this morning put out a bullish note on IBM. It exactly offset the Nike drop. So I said, look, that's just blatantly manipulative. I mean, they do these things to prop up the market. UBS didn't want the Dow to go down. So when the Dow starts going down, they jam out a note saying, oh, IBM should be much higher. People start buying IBM. It offsets the decline in the Dow. That's how you fix the Dow. Anytime you want to, you just upgrade or downgrade certain stocks in the Dow, and the thing moves up and down. And I said, well, that would be dishonest. And then I'm like, look at this. Regulators fine UBS and Deutsche Bank for spoofing commodities trades, another penalty for manipulation, another penalty for manipulation. And I said, well, wait, you got to just summarize it. If I start pulling all the articles where they've done bad things, we'll be here all day. So these are their primary, the 10 primary offenses committed by UBS. It's literally just UBS. Benchmark manipulation, 4 times, 1.6 billion in fines. Toxic securities abuses, 4 times, 1.5 billion in fines. Tax violations, twice. Banking violation, once. 11 times investor protection violations. One time price fixing anti-competitive. 4 times economic sanctions. 7 times wage violations. 6 times securities trading violations. This is one of the world's top banks, with $5 billion in penalties over the last 10 years or so. Meanwhile, they made $60 billion in profits. They don't give a crap. That's how they made their profit. You don't make these profits by magic. Carl Icahn doesn't make his profit because he's a genius. And neither is Soros. They're guys who are willing to skate the edges of the law to work the system and manipulate the markets to their advantage. And that's what these banks do. This is why they call banksters. They are not straight up people at all. They're freaking criminals. They get fined all the time. But the thing is, you can't put them in jail because it's a corporation. So corporations have all the rights of citizens, yet you can't penalize them other than with money. And they don't give a shit about the money. It's very simple math for UBS. They say, well, gee, if we played straight, we'd make $30 billion. But if we play crooked, we make $60 billion and pay a $5 billion in penalties. I guess we'll play crooked and make the extra $25 billion. It's not a hard decision for corporations. They also have no morals. That's how things work. So, you've got to be an investor. Because the traders are the guys that they're screwing here. The traders are the guys that are getting jammed up by these people. They don't care whether you win or lose. They put out these reports. Goldman Sachs too. Goldman Sachs bullish on or bearish on or bullish, whatever they need to make their numbers that month. That's where Goldman Sachs goes. And this week we were talking about the bullshit with oil was 72, and we were shorting it up here. Now it's 70, just hit 71.50, which is a $1,000 drop from 72.50. Because we know it's bullshit. This was just bullshit by OPEC. And look at the spike in volume and the spike in price. And I wrote that morning, that was only that was Tuesday. I said, short it. There's nothing fundamental change. Just because some oil minister says some crap doesn't mean anything. You've got to look at what the real situation is. And the same goes for stocks. We were talking about GE today. And GE is down yet again, unfreaking believably, because somebody downgraded them. But you know what? The guy who's downgrading them, he's probably he's accumulating, or his friends are accumulating stock. Oh, it's up now. But GE spiked down to a new low today. It hit 125, 1125. And it's the same thing, because what I said in chat about GE was the 2021 10-15 bull call spread we rolled to. How is that? Why does it say it's up 6 cents? Oh, it's 11.33 because that chart's behind. And literally we're talking about over 6 cents. But you see, this is the thing. Here's J-Bo. What the fuck? Every day new low. It doesn't. I don't give a shit what the chart says. I care about the numbers. Okay, we took this spread, and this spread is now net 24.50. Another one. This didn't even make the cut because I'm not so sure about it as I am about those other nine trades. But this is another spread, brand new. If you do it now, it's net 24.50. It's a $40,000 spread, and all GE has to do is get back to 15 in 2 years. Now, I said, look, GE only made $800 million last quarter, and they project $8 billion in profit for the year for 2018, and $8 billion next year in profit. Now, in the past, on similar sales, they've made 15 billion, 13 billion, 13 billion. So they're capable of making much, much more money. But at the moment, they're restructuring and doing stuff, and they think they're going to putter through with 8 billion in profits. And people treat them like they're going to go bankrupt. They make $1 per share. It's an $11 stock. If you give them $11, they give you back $1. That's not bad. And you can sell options to because people think they're going bankrupt. You can get these insane option prices that pay 20 to 1. And like I said, that's what I'm not even sure about. That compared to the other line I put out, I'm not even sure about it. And here's J-Bob's answer when I told him that. I said, look, there's no quick way to know if the trading fundamentals are going to show up over time. It's a 2-year position. You can't stare at the thing every day. I'm not panicking, but I've been getting slammed since the stocks and selling puts and calls at 28. Yes, my break even is well below 18. Seeing a drop $1 might be scary, you know. So whatever. But I don't care what the price is. You know, when the World Trade Center went down in 2001, for like a year after it, the apartments across the street, the apartments in Battery Park City, first of all, there was debris and dust and everything, and Battery Park City got damaged from debris that fell, and the roof crashed in and whatever. There's a whole big apartment complex in Battery Park City, condos. And condos that were $1.5 million were going for like $250,000. People just, it was a horrible place to be. You did not want to be there at that time. It was depressing. So people were selling and moving out. Plus you're worried about what if the terrorists come back and so on and so forth. So things were just crazy, crazy cheap. And at the time, I said to some people, I'm like, we should like buy a dozen of these things. So I said they'll come back eventually. I said, look, people are going to want to live in Lower Manhattan. They're going to rebuild the World Trade Center in a few years. And it took longer than I thought. They're going to rebuild the World Trade Center. Anyway, so those apartments now are like double what they were back. Not double what they were then. They're double what they were before the crash. Everything's like way up now. They're $1 million+ apartments each. Or $2 million apartments each now. If you have money and you're patient, you can make the money. But I was going to say, so the point being though, that when the apartment goes for when the apartment is 1.5 million goes for $300,000, you buy it for $300,000. If it goes to $200,000 because people are still panicking a year later, you could say, oh my God, now it's $200,000. I lost 1/3 of my money, blah, blah, blah. It's so horrible. It doesn't matter what you lose on paper. If you don't sell it, you didn't lose anything. You don't check every day to find out what the lowest price somebody sold something for. You've got an apartment, you think it's worth the money, you think it's a long-term investment, so you treat it like a long-term investment, you don't do anything about it. And think of how many things in your life you do that with, including your home. You don't check your home's value every day to see if it went up or down. And your home's a much bigger investment for most people than your stocks. You should check that every day. And what are you going to do? Sell it, move out? No, you bought a home because you thought it was a good investment, and you're going to sit in it for 20 years. Why isn't a stock like that? Why do you sit there and stress and worry and sweat over these things? I don't care that there are people who think that they should sell their GE stock for $11.25. They're not my problem. And yeah, we're down $20,000. We have 80 longs, and we're down $20,000. So we need to get $3. We need to be at like 13 just to break even on our overall trade. Because like J-Bob said, we started like 8. We started higher. In January, we started up here with GE. We doubled down, then we did whatever it ended up with. But now we have a lot. We have 80 long spreads. And we didn't start at this price. We already have a $20,000 loss from all this crap going down. But now we have a position that costs $20,000 net, and it can return up to $40,000. So we could still make 100% in 2 years. And obviously, compared to some of our other spreads that make 1,000%, it's not that exciting. But I'm happy, but if your losing trades get you back to even at least, then you're fine. Then the winning trades are going to make up for it. Every trade doesn't have to be a winner, and every trade doesn't have to, and not that many trades can turn out to be a catastrophe. I mean, frankly, the way GE is, the fact that we can still make a good amount, the fact that we break even at 13 now is pretty good. And if we have to, we can adjust it again. But right now we're break even at 13. We can live with that. So that's what we're sitting on. But again, it's ridiculous because the company should be, the PE of GE should be about 15. So 15 is the right price if they're making $1 a share. And this is during a big, huge turnaround where they're restructuring things. Once they're done restructuring, this number should go back to 13. This will be $1.50 a share, and they'll be worth 20. But not tomorrow, and not next quarter. And it says right here, not next year, not this year, not next year. Maybe 2020, probably 2021, you'll start seeing those 13s again with the billions. You'll start seeing $1.50 a share in earnings. That'll be nice. But what it does today, tomorrow, what does that matter? Stocks go up, stocks go down. You've got to pick value stocks, stick with them for the long term. And you've got to take positions that you believe in and ride out, like my NASDAQ short, which I doubled down on when it went against me. And now I'm making good money. I'm making twice as much money as I started with. See, 390. So where is it good? Where to go? Now so far, now I got to find it going down. There it is. So let's say now I put a stop at 76.45 because I want to lock in the money. But it's up 450, 460. Remember, because when it went up to 760, I said, well, I don't buy that. I think this is stupid. So I just added, instead of getting out of it, I said, oh, no, I'll add one. Give me a better average. So there's a quick 500 bucks. So, you know, there's no trick to this. We watched the Fed, we had an opinion, and we traded it. And you see what happened? The dollar spiked. So because the dollar spiked and shot the thing down, I'm less inclined to keep it because it's only moving with the dollar or against the dollar. So it's not really going down on its own. Now, the Dow's down a lot more than that. The S&P's down a lot more than that. So probably the Nasdaq will catch up a bit. So hopefully I won't get stopped out, but I'll put a stop at 76.45, I think. So you can salvage 400 bucks at least. Well, there you go. I blew through my thing. Oh, you bastard. Oh, there it goes. See? Don't chase it. It'll come back. That's 370. 380. Yeah, I'll take it. 380. Okay, so we made 375 bucks. All right, not so bad. Not so bad for all that hard work we did, right? And why did I get out? Because I'm watching the dollar, and I don't like it because the dollar's spiking up and down. I don't know which way it's going to go next. If it goes lower, then this will go higher. And plus, I got to get back to work. I got to go back to the live trading, to the live chat room. So I'm done with that, and I don't need to watch it anymore. But that's that's how you make a quick 380 bucks. I mean, what it takes is like 10 minutes. You know, well, since the Fed, right? So it's actually been an hour since the Fed. So it's been an hour. Wow, I went by fast. Or less than an hour, whenever we made the trade. But you get the point. And at the moment, you know, because the dollar swings so wildly, I don't want to stay in the trade. I'd rather just take the money off the table, got 375 and buy dinner. I'm happy. All right. Last questions, and then we're out of here. THC trade. Why isn't the bull call spread 25.37 instead? Wouldn't 25 be a better support strike? Because we think it's going to go lower first, so we don't want to be. I don't know. What was my THC trade now? I don't remember. I think it's because because you can always roll to a lower trade. So the goal here was to have a credit. Okay, you can always use that $3,500 credit to improve your 15 longs, right? You can spend for $3,500, you've got $2 per position if you want to roll lower. And that would easily cover the 25s. So you can actually roll down to like the 22s or something like that with that. But the point is, we think it's going to still head a little bit lower than this. We're mostly concerned with covering the 28 calls for the moment. And then when we get to the next round, we'll decide whether we want to widen our spread or get more aggressive. But it's cheaper to roll these calls to a lower strike after it goes down, because the lower strike has a higher delta than the higher strikes. So we would widen the spread. We're not going to change our target. We still believe it can hit 37 in 2 years. Don't forget, we still believe it'll hit 37. But I'm certainly happy to widen the spread if it goes lower. But if it goes lower, we're also going to have the ability to sell some puts. We only sold 10 puts. So if it does go lower, we'll consider what we can do about selling puts or whatever, selling more puts, rolling the puts, whatever we do. But right now, my main job is I'm only looking to collect this 3,000 bucks. I'm looking for Christmas money. Oh, so by the way, so all those added together, including CMG, is $101,000 that we can make between now and April 1st. Not April 1st, sorry, January 1st, or January expiration date. Without CMG, it's $26,000. CMG being the bigger trade. So in a regular portfolio, you could easily do the other ones outside of CMG, and that is a fantastic rate of return. So I mean, that's what you do if you want to pick up some quick money between now and Christmas. You do that. Don't forget, this is 1 quarter. And like I said, if I do this in my portfolio every quarter, I can pick up $400,000 more on top of the regular money we make from just having good long positions. All right, so thanks everybody. for coming, and we will do this again next week. I'm going to get back to the chat room, and we'll figure out what to do about the longer term trades on the Fed. All right? Thanks for coming by, though. Oh, look at that. Ugh, so tempting. It's tempting to get back on the short train here. I'll have to consider that. All right, we'll see. All right, guys, take care. Thanks for coming. Have a good day.